Hey traders, welcome to the top tier outlook for Sunday the 10th. We're embarking on the week of the 11th, which is a big week. We've got FOMC. This is the last time we'll hear from Jerome Powell. This is the last monetary policy statement we'll get. And this is gearing up to be what will end in terms of monetary policy expectations for 2024. This will sort of end the year with, hey, are they going to cut or not? Now, that's not really the question because, frankly, we already expect, we meaning traders, investors, looking at the target rate probabilities, we are taking a look at a very dovish set of Fed fund futures for March and for May and for June and for July. We are expecting at least 2 rate cuts by, at this point, July. Now, the non-farm payrolls didn't do anything to change this. We do have some data this week, which if Powell was not speaking, would probably be a big deal. CPI is obviously a big number. PPI would be another, but since we're hearing from Powell on Wednesday and we're getting CPI on Tuesday and PPI on Wednesday, we get to hear it from Powell. We get to hear after he sees the data. And therefore, as long as the statement continues to support expectations that we're going to see rate cuts, gang, let's just go with it. Now, why does that matter? Because this week we also have another phenomenon known as triple witching. So we got a whole bunch of stuff. All the stuffs are going to expire on Friday. And the December contract for the S&P, for the NASDAQ, for the Russell, for the Dow are all in the process of rolling to March. And so the ESZ, the December contract, is again going to end, and the March contract is beginning, and there's a strange overlap. The roll date was Friday the 8th. So when you start to open up your trading platforms this week, most charting platforms will have rolled to March 2024. Be aware of that. Check whether or not your platform has left the December contract and is now reflecting March. And you'll notice the open interest and the volume are all going to move out to March as well. Friday is it. By Friday, we'll know the close of the December contract and we'll officially have that gap. Right now, the gap's about 53 points between what's happening in March. Here's ES24 at 46.60, basically in a quarter. And here is ES Z23. See there, 46.07, 46.08. The difference between those two is going to be the gap. And March is gapping higher, and it makes sense why March would gap higher. One of the things that I'm writing about in Top Tier Outlook this week, and by the way, Top Tier Outlook is as much, this is what I'm trading and why, as it is a little bit of education as to why we have the expectations we have about macroeconomics, about trends, and for example, this week, I'm going to talk about rollover gaps. Last week, we got into earnings season because it's not too soon to start thinking about what's going to happen with Q1 earnings as we are 6 weeks out from the financials, which kind of kick off the official earnings season. So lots to think about as we're wrapping up the month. So this is roughly the gap. Now, the thought is that at some point, we'll come back down, test that December close, and then continue. Now, keep in mind, gang, gaps don't have to close immediately. They don't have to close in one day. It will eventually probably, close, but it should not undo. So the question is, let's say, for example, the gap ends up being, say, 46.10, right? 46.10 for well, let's say December closed at 46.10 and March is wherever it is. The question really is, if for whatever reason the March contract were to trade down to 46.10 or 4600 or whatever it is that December closes out on Friday, would that undo the trend? Oh gosh, no, right? if we stay above 4,600, if we stay above 45.93, that's very much in line with where support has been as the March contract is gaining more and more attention, open interest, and volume. Staying, quite frankly, above 45.50s is perfectly fine. So the question is the gap going to upend, closing it, going to upend the March uptrend? Not even a little bit. I wish the gap were larger, because in that way, when March does potentially close, it gives us a better buy the dip at the mean reversion of the wave. So these are the things I'm going to think about. Now, I just did this for the S&P. This will apply to SPY, SPX, MES, micro futures. But remember, we need to and can do this exact same process for the NASDAQ, right? NASDAQ December contract versus NASDAQ March contract. And those are things that are, again, ask yourself, if the NASDAQ March contract trades down to wherever the December closes, is that going to undo the trend? And if it's not, hey, I hope we get the gap close come sometime in January, where we get the window undressing, unrally, right? Which often happens because strength gets stronger into the year. The window dressing happens. Window dressing is what? Window dressing really is a superficial thing, right? It's just for show. It's putting the best stuff up in the display window. That's not what you keep there, right? So when you think about January and you say, but Rog, a lot of times we end up with a lot of weakness second, third, fourth week of January. Why is that? By the way, really good bubbly water. This is Mineragua. All of a sudden, Topo Chico was really tough to find down here in South Florida. And this Mineragua stuff is really pretty darn good. All right, so the movement lower, we'd love to capitalize on. It's not going to undo the trend, and oftentimes the timing will be the opposite of the strength we see at the beginning of December to the end of December. We'll have the window undressing rally in January. All right, so with that being said, as always, gang, best part of our show is your questions. Of course, remember, we're going to have charts and coffee throughout December. I'll be taking, obviously, Christmas Day off, but just to give you an idea, heck, I think I've actually done a Christmas Day charts and coffee, because why not? But I won't this year. So we won't be taking any time off other than that Monday, Christmas Monday, this month. And so, as always, you can join me for Charts and Coffee Monday through Friday at 9 a.m. All right, now let's see what we've got here. Am I having a good weekend? I am, Nick. I hope you are as well. What are my thoughts on the euro? So if we're looking at spot, right, euro versus US dollar, spot, let's see here. Look, I'm bullish euro, generally speaking, and I've been looking at 6E, Nick, to be quite frank. That's the way I've been looking at that, because it's just a more accessible symbol for most traders who are open to futures, but may not necessarily be trading Forex. But definitely Forex, largest market on the planet, and the best way to look at currencies, sitting at the 200. I don't want to be bearish the euro, but I will say the ECB and Lagarde, Nick, as of the last few public appearances, they're starting to sound a little dovish, which means rather than the euro continuing to gain against the US dollar as we're expecting those cuts, euro US might start to find a little bit more of a bullish chop. I say bullish because for now, euro US is above the 200. Those are the white dots on my daily chart, which is the chart on the right on your screen there. So I would say bullish chop, because as long as we're starting to see a little bit of dovishness, dovish talk, meaning expecting rate cuts from the European Central Bank, it's going to be tough for the euro to continue to gain on the US dollar. Both these central banks are going to potentially cut rates. US will likely go first, though. So maybe that gives an edge to the euro. And I would rather be a buyer. But, I guess the question is then, what is the best trend out there? Do I have to trade the euro, or are there better trends? And I'll tell you right now, in terms of the currency adjustments we are seeing, I'm being pretty patient about where I want to be bullish US dollar, where I want to be bearish US dollar. Aussie US looks pretty good. Australian dollar, because it's hard not to be a bit of an Australian dollar bull if we're going to start to see strength in commodities and strength in equities. And actually, Aussie's going to also benefit from a lot of the strength we've been seeing in the US dollar. So I like the currencies. I'm just not sure which one it is that I want to at the moment, Nick, buy against the US dollar. And remember, it's always versing. I know the kids use this word, and now it is a word, right? Versing. It's not always whether or not I want to buy the US dollar or sell the US dollar. I want to short it for the most part. But the question is against what, right? And that's where I think it's still a little fuzzy as to which one I'll have to consider. All right. Tony, yeah, I'm not expecting fireworks from PPI to CPI. To your point, would be a much more impactful release. I am expecting most of the fireworks to be around Powell, but gotta make sure that I'm focusing on any of those data points that could just strengthen expectations about what we expect to hear from Powell. And if inflation numbers via PPI, CPI show that inflation continues to drop, we are going to be looking for a rather dovish monetary policy statement, and most certainly a dovish presser from Powell, right? All right. So by the way, gang, if you haven't already, come check out what we're doing over at sectorsecrets.com. This is where we take all the things we talk about here in Top Tier Outlook and all the things we talk about in Charts and Coffee, and we take the trades in the room: day trades, swing trades, long-term portfolio, and this very Top Tier Outlook newsletter that I'm working on here Sunday night, that's going to be posted tomorrow morning, and all members of the Sector Secrets Mastery get access to this with their membership. So if you haven't checked out what we're doing, sectorsecrets.com. Look, the markets are not easy right now, and having some guidance is really important. Having a community around you is really important. This is still not just full steam ahead. Likely that's going to become next year, late January, early February, but this is still a difficult environment, and having the community makes a big difference. All right. Next up, what is window undressing? So, Grace, if window dressing is strength gets stronger, we want to put the strongest names on our buy list, because money managers are going to be padding their portfolios with the things that look good as the year ends. Window undressing is no money manager wants to be holding, say, Microsoft or relative outperformers to the upside at their highs. Those positions are often unwound then, and what happens is sector rotation. So window undressing, in a way, is sort of that sector rotation we tend to see the first part of the quarter, first part of the new quarter. All right. What are my thoughts on VIX and how it may influence the futures market? My ultrasound, I will tell you, I don't believe VIX is the thing that people think it is. Okay, I know you sound like a heretic, Rog. First of all, gang, think about market internals like VIX. I mean, VIX is a futures contract. It's VXX or VIX, but whatever it is, it's measuring the S&P in a way that it is not actually composed. So I could go into my typical routine about high concentration weighting, but the simple answer is it is not what people think it is. How many times have you looked at the VIX and said, gosh, it's really not reflecting what's happening in the S&P today. It's really not reflecting what's happening in the broader averages. There's a really good reason for that. It's not that the VIX is broken. It's not that it's not measuring what it's supposed to be measuring. It's simply not measuring the S&P in the high concentration weighted way in which it is actually designed. And that's why things like VIX as a leading indicator or any kind of indicator of whether equities are going up or down, it just makes no sense. And don't take my word for it. Go look at what the VIX is. Look at how it's made up. I think it's a cool futures contract. Don't get me wrong. Once you understand what the VIX is at a computational level, go take a look at what the S&P is in terms of high concentration weighting. And then you'll say, wait a minute. Most market internals, including the VIX, are not high concentration weighted. So how can I look at the VIX to reflect something that it's not even weighted like? I hope that makes sense. So what are my thoughts? They don't. It does not. It does not. I think a lot of VIX is self-fulfilling prophecy now, right? Traders see the VIX go up or down and they think That's what they should do. So then that's therefore why they do it. I think at this point in high concentration weighted modern markets, the VIX is absolutely just traders behaving in a certain way because they think they should. All right. Okay. Gold. I want to be a buyer. Jay Charles, want to be a buyer. Gold's in an uptrend. I absolutely want to focus on the long side, buy the dip in gold. Yes. How about a short on PFE? I'll tell you this, Munir, of all the things I could do, I'd rather focus on the long side. Yes, tax loss harvesting is a reality. Healthcare and weak stocks in healthcare are a fantastic choice. So let me tip my hat. Kudos on the choice of name to want to short, whether it be PFE or BMY. There's very little that's bullish in healthcare. UNH comes to mind and Lilly comes to mind. So I love it. But here's what I will say, Munir, if I'm going to put energy into my positions in December, I like the 1 hour time frame choice because we're running out of time in December. We're about a third of the way through. So 1 hour time frames are going to be fine for the overnight swings, but I'd rather be looking at long positions due to the chance that more strength is out there than weakness, due to the fact that, yes, while XLV and XLE are very weak sectors, there's so much to want to buy. And think of it this way, the wind at our backs is not just Santa, right? Santa doesn't happen until the end of the month, gang. Santa is a December 22 to December 29 thing, if it's even going to happen. Window dressing is really the last bit of window dressing is Santa. All right. That said, the thing at our backs is Powell. The thing at our backs is upcoming rate cuts. And so I'd rather be long for all those reasons, mostly macroeconomic. Window dressing, bullishness, plus expectations for rate cuts. To me, the long side is going to be the better way to go. And that's the way I'll view this month into year end, but specifically in the places that are in uptrends. And the last couple issues of top tier outlook, I've gotten into which symbols we want to look at for the follow through to the upside. Why? In terms of index sector stock hierarchy, and also looking from the perspective of not only the strongest indices, NASDAQ and S&P are the best, not just the strongest sectors, XLK, XLC, XLY, XLF, certainly are the best, but then what are the stocks weighted within those that are the outperformers? Emphasis on relative, gang. Remember, I'm not scanning the broader averages and thousands of stocks based on some subjective group of indicators that are all doing the same thing and then therefore spits out a list of symbols. Those are disparate names. They don't really have anything in common in terms of why they're moving the way they are within the broader averages. What we're looking for is relative performance. What's the relative part mean? Relative means what sector, what indices are these stocks included in, right? Why are they moving together? Why are they lumped together? Why do I look at UNH and Lilly? They're all in XLV. So then if I'm looking for relative outperformance in that group, kind of like a school of fish, right? Which one are the best ones? Which one is strongest? Which one are showing the signs and characteristics of high probability uptrends? And therefore, which ones do I want to buy when they pull back, right? I'll give you two examples. Apple, right? Apple, we have a long position in. JP Morgan, we have a long position in. All my cards on the table, gang. We got shook out of GE, not because it's not a great trade, but I was too aggressive, right? We also got shook out of Intel, not because it's not a great trade, but I was being too aggressive. Something I will not make the mistake of doing the remainder of December. So we took 4 swing trades. Sadly, all 4 are doing pretty darn well. 2 of them are doing really well. And the 2 that we got shaken out of is because trading, gang, is not a target. Trading is the journey to the target. And if that journey is untenable, if that journey is too difficult to manage risk without severe damage to your account, we let it go and stick with the things that are working. And that's exactly what we're doing in the mastery. As always, gang, thank you so much for being here for Top Tier Outlook. And yes, the rate cuts are being priced in. This Wednesday, we'll hear again from the horse's mouth. And if that continues to be more dovish discussion, sort of a victory lap over inflation, look for those cuts, gang, because yes, they are absolutely being priced in to the Fed fund futures and therefore the target rate probabilities. All right, gang, be good to each other. I'll see you tomorrow for Charts and Coffee.